2020 could flip the script. For a decade, U.S. large-cap stocks outperformed emerging markets, but will the trend swing in the other direction this year? Our next guest thinks maybe it can. Joining us now is Nuveen Chief Investment Strategist Brian Nick. Brian, you favor non-U.S. assets to start the year. I feel like we have been hearing this a lot here to start off 2020. What is your rationale?
We certainly have. And I think if you're just looking at valuation, which has seemed to favor non-U.S. assets for the better part of a decade now, that's not a good reason to invest over a one-year period. If you're looking at quarters at a time or even a few years at a time, it's not going to be a good predictor. But we think the environment is going to be somewhat more friendly to non-U.S. assets. The dollar is quite strong. We've seen a little bit of a weakness as it looks like growth picks up in the rest of the world. We have Brexit sort of behind us now. Seems like the worst of the trade fears are behind us. So in an environment where we think the global economy is actually moderately accelerating, which we think it will in 2020, that has historically been a better time to be in non-U.S. assets versus U.S. And the fact that the U.S. market has kind of melted up in the last quarter or so gives us a little bit more conviction on looking elsewhere for higher returns.
Is there a percentage that you might share with investors about you want to have maybe 40% right now in U.S. assets, whereas because of the opportunity you see, it would be good to have maybe 20, 30% in international assets, and then what would the breakdown be? So
the normal breakdown for us, U.S. versus all non-U.S., including international and emerging, is about 65-35, which is clearly a home-biased portfolio for U.S. investors. We think that's appropriate. Currency volatility tends to just add noise, so you tend to want to be a little bit more home-biased. Right now, we're slightly overweight the non-U.S. Developed part of the equity market, so we'd probably be closer to, call it 37-38%. Not a huge overweight at the moment, but one thing we think we could potentially add to it if it looks like we've gotten the call right in a macro sense, and it looks like that this is going to be a better year for international. So far, so good on that front.
So aside from developed, though, you also have your focus on emerging markets. What specifically are you looking at right now? Are we talking China? Are we talking maybe Southeast Asia? What are some markets you're liking?
So high conviction areas in emerging market equities are Brazil and China. We obviously need to see, I think, the signing, at least, of the trade deal, and then some nod towards what the next steps are going to be to make sure we don't kind of relapse from this like we have from past deals. Brazil finally looks like it's delivering on the growth front. It's been a disappointing growth story for about 3 or 4 years now. We keep waiting for Brazil to kind of escape. This looks like the right moment for it, and that we think will also benefit Latin America. We're also pretty bullish on the fixed income side. That's where we have more of our emerging market overweight, because if you compare emerging market bonds to bonds in the U.S. market, the spreads on U.S. bonds, corporate bonds, are basically at their cycle lows. Emerging markets are not even at their 12-month lows. So we think there's more room for convergence there. Some of that is this, I think investors are a little bit skittish because there's been all that risk around EM and the trade war for the last 2 years or so.
So, Brian, when we look at U.S. equities, obviously earlier we were talking about how the Dow hit that 29,000 level. I'm wondering, as you're looking ahead, what catalysts are you thinking about could be pushing those markets higher, especially as we have soothing when it comes to U.S.-China trade? Iran, kind of, the market shrugged that off a little bit. Same with impeachment news. So what catalysts are you looking at ahead? Yeah, the unfortunate thing is we think a lot of the catalysts are behind us, which means that we think a lot of the progress has already been made in the markets. Our target for the U.S. market at the end of this year is about where it is now. We're not looking for a lot more kind of upward surge, because a lot of the things you mentioned, the Brexit kind of resolution with the UK election, the US-China trade deal, the Fed having delivered 3 rate cuts and seeming like it's not likely to deliver a lot more, at least based on the data that we're seeing. It's hard to find that catalyst. Where you could find it, though, is the big missing part of the market story last year was the individual investor was pulling money out of stocks all year, out of ETFs, out of mutual funds tied to stocks. If you start having a fear of missing out trade, you start seeing people looking at their fourth quarter statements saying, gosh, I should really be in this market. We were up 32% last year. That has historically given another leg or two to a bull market run, not just in this cycle, but in prior ones.
And that could also presumably finally bring back the volatility to the market that people have been looking for. Because if individual investors finally get in and then there's a pullback, could that exacerbate a pullback, for example?
It could, and not just in the equity market. I mean, look at the inflows into municipal bond funds last year. $1 or $2 billion a week going into municipal bond funds. So not that big a market to take that many inflows. And as a result, that was an outperforming asset class last year. If you start having people pull money, not just out of cash and off the sidelines, but out of bond funds or other funds that they've been kind of storing money in, waiting for the right moment, if they think this is now the right moment for stocks, you could see volatility in both directions.
With the municipal bonds, wasn't that a tax play? And when you talked about emerging market debt, essentially, we had a guest on yesterday who warned, especially because there's this fear of missing out as people are chasing yield and willing to take on risk, that one good recession tips a lot of these emerging market governments into a really precarious situation because they have taken on too much debt.
Some of them have, but we also think it's a much more diversified asset class, sort of internally diversified than it's been in the past. These economies don't rely as much on the big macro story as they once did. So you're going to have the turkeys. That's going to be every year. You're going to have a story like that where there's a government that sort of gets things upside down. There's an outflow and there's a big sell-off in the bond market, but that doesn't necessarily translate into struggles in, say, East Asia or Latin America, the same way that it might have done in the mid-2000s when it was very much kind of an up or down trade.
I think you may have answered it in this question, but I was just thinking that, we often think this correlation between stronger dollar and EM, right? That's usually not a good thing for dollar-denominated debt with EM. So does that suggest that you think the dollar is going to continue to push lower? It's going to be weaker? If you're putting your money in EM and you're expecting that to push higher, what does that mean in terms of the trajectory for the dollar?
Yeah, we have a sort of a moderately bearish call on the dollar. I think if we see the dollar move a lot this year, it's going to be against emerging markets in a weaker direction. I don't see a lot of momentum for stronger euro, stronger yen this year because those trade very much on interest rate differentials. And while we may see higher interest rates across the board this year, I don't think we're going to see Europe catch up to the United States. I don't think we're going to be seeing any hawkish rhetoric out of the ECB, certainly, or the Bank of Japan that would make people think that, gosh, I should now maybe consider owning yen or euros. If you start thinking about other currencies, though, it seems like every morning we come in, the Brazilian real is doing a little bit better. Other kind of higher beta emerging market currencies doing better on days when there's not a lot of new news, and even kind of weathered the Iran conflict, which seems like it's now kind of off the front burner relatively well. So we're actually pretty optimistic that EM currencies are poised to do well, not because the dollar is going to be weak necessarily, but because those areas look more attractive to global investors.
All right, Nick, good to see you. Thanks for coming in.
You too. Happy Friday.
Thank you. Nuveen, you too.